Hello everybody and welcome to our HUBsights webinar. We're delighted to have with us today Don Huber from Franklin Templeton in New York, and also Nick Bulgren and Paul Ashworth from Commsec. So just a few housekeeping items before we kick off. The lines will remain muted throughout the presentation to prevent any background noise. So if you've got any questions, please submit them through the webinar control panel, and we'll present them to the team after both presentations have been done. So the Q&A will be at the end of the session. So that's about it. So now I'd like to hand over to Don to begin his presentation.
Great. Thank you. Thank you all for the opportunity to speak with you. Today I want to talk about e-commerce and the growth of e-commerce and some of the companies that we are finding that you may not know of who we think are attractive candidates for ownership in the space. Now, it's not news that e-commerce is growing rapidly and taking share from brick and mortar companies. After all, Amazon's been around for 23 years now and is kind of a household name in a lot of parts of the world. Online travel agents companies like the one that owns Bookings.com or Booking.com have really revolutionized the way that we buy air travel or pay for air travel and hotels. And Alibaba, clearly a household name and well-known really throughout the world, having originated with e-commerce in China. And brick and mortar companies are suffering. Up in the upper left on the first slide here, or second slide, we show abandoned shopping malls, which are dotting the American landscape. And arguably, the U.S. was over-malled and over-shopped to begin with, but shopping malls are going out of business, and it's not an uncommon sight. Now, on the right-hand side, we show a picture of what used to be Lord & Taylor's headquarters. And Lord & Taylor is a venerable U.S. department store, been in this location on Fifth Avenue since 1914, and really in a sign of the times, just recently sold the building to WeWorks, online provider of shared office space. And here in Australia, retailers are feeling the same kind of pressure. We show on this slide retail foot traffic in stores, brick and mortar stores throughout Australia for the last year. The brick and mortar companies and retailers are fighting back. They're moving online and expanding their online presence. They're offering something that e-commerce companies can't, which is order online and pick up at your local store. And they're doing some really creative things, like a magic mirror that's rolling out in some retailers, where you can walk into a dressing room and look in a magic mirror and see how an outfit in different sizes would look on you without actually trying the outfit on. So what's driving this increased penetration of e-commerce? Well, there are a few things. One is increased penetration of broadband, smartphones, and tablets. And smartphones and tablets are particularly important. They're really what's driving e-commerce now is the mobile commerce. Millennials clearly grew up with the technology and very comfortable in purchasing online. For the rest of us, we've gotten past that stage of saying, I'll never put a credit card information online or never order online, and are now comfortable with it. And part of that is the ease of use, the way the companies have invested in order to make the online shopping experience easy and delivery fast. Certainly cost efficiencies, whether it comes from scale of purchasing. So Amazon, clearly one of the biggest producers of a large number of items and can drive down the price. But also the cost advantage, because clearly online stores don't have some of the same costs that retail stores do. They don't have to pay for owning or leasing the store. They don't have to stock and staff the stores, and they can pass those benefits along. But the last point here that we make is data, and that's clearly where online retailing has a meaningful advantage. And if you think of it in the days of e-commerce and social media, e-commerce companies have much better visibility into trends, popularity, customer feedback. They're better able to target specific users or their audience. And you think about the data that an online retailer has on you, the consumer. You know, you're not just walking into a brick and mortar store and making a purchase and walking out. You're buying something or items repeatedly online, and that retailer knows what you've bought, they know what you've looked at, they know what you're interested in. If they link in any kind of social media, they really have a good idea on how to target you. The e-commerce has a few benefits that really kind of work in what I think of as kind of a virtuous circle type of methodology. I mean, you have more users often as a first mover advantage, and you attract more retailers, or you can pay for more SKUs or items to have online. And that in turn brings more users, which lets you stock more items. Or a broader way to think of it is you have more users and more retailers and more SKUs, and that gives you the cash flow to invest in ease of use and improving the website, in developing delivery options and faster delivery, which brings more users, which brings more retailers, and again, kind of a virtuous circle. Now, I mentioned Amazon and Alibaba, and certainly those are well-known names throughout the world in terms of e-commerce, but there are others that have the same benefits, have the same growth, or the same runway ahead of them in terms of their growth, if not even better than some of the better-known companies, but they're just not as well known. And this is really typical for our strategy. We like pure play lines of business. We tend to move down the market cap spectrum where we can find companies with sustainable growth for a number of years. Moving down the market cap spectrum has another benefit in that the companies that you're owning as you move down tend not to be as well followed by sell-side analysts and not as broadly owned by other managers or other portfolios. And so they bring a diversification benefit to our clients' portfolios. So the three companies that I want to talk today about are Mercado Libre, Just Eat, and Shopify. The first one is Mercado Libre. They are the leading e-commerce site in Latin America and the 7th largest in the world. They were started in 1999 from a business plan developed at the Stanford School of Business and still run by its founder. In Latin America, broadband penetration is low and rapidly increasing. Credit card penetration is low and rapidly increasing. And e-commerce penetration, which on the earlier slide I showed is 10% globally, is about 3% in Latin America, but increasing rapidly. And Mercado Libre has a first mover advantage in their markets and really benefits from this virtuous cycle. In terms of a business model, they're an asset-light business. They're not selling their own goods, unlike Amazon, so they don't have to pay to keep goods in inventory. They're just a storefront for third-party sellers. At its core business, they're a marketplace, so they're linking up buyers and sellers. They continue to increase the items that they're offering and the number of retailers. In the last quarter, items listed on the site increased by 50%, to give you an idea of the growth. And they continue to attract more users. In the last quarter, registered users at the site increased by 40%. So still seeing strong growth despite the fact that they've been around for a while. One of the first additional services that they offered was payments. And again, if you get back to or think about the environment where credit card penetration is low, you need to facilitate payments and provide for something other than having a buyer go down to the seller's bank and make a deposit, which is what used to have to be done. So they developed Mercado Pago, which is similar to PayPal. It's now used on 80% of their online transactions. They offer advertising. You can pay for, just like you can with Google, you can pay for a better listing. When a user searches for goods, you can pay for banner ads, you can pay for classified advertising for items not sold on the site. One other important area that they've expanded into, again, to facilitate transactions, attract more users to their site, is offering shipping logistics. And they started this in 2013. Now about half the items sold on their websites use Mercado Envios for shipping. They've begun to offer free shipping in Mexico and Brazil to start, and some of their other markets. And they're doing this really market by market. And this is driving tremendous growth. So in Mexico, they've seen growth of over 100% for the last 3 quarters in a row. In Brazil, they've seen growth of over 60% for the last 5 quarters in a row. Now, there is a negative side to this free shipping in that they are either paying for the shipping themselves or splitting the cost of shipping with the sellers. And so we're seeing an impact that this has on the margins. And that's really the one thing that we're watching, or the main thing that we're watching now, is how the business progresses. Clearly, they have a strong first mover advantage. They are well positioned vis-a-vis Amazon, which has been in Mexico for the last couple of years and is entering Brazil now. And we think they're making the right move to continue to attract new users and sellers to the site. But in the meantime, we are seeing some margin decline. Next company I want to talk to is Just Eat. They provide online ordering for restaurant takeout and delivery. They started in Denmark. They're based in the UK, and that's their largest market now. And they entered Australia a couple of years ago with the purchase of Menulog, and have Menulog and Eat Now as their brands in Australia. They too benefit from this virtuous cycle that I'm talking about, where they have more consumers, more purchasers, which bring in more restaurants, which bring in more consumers. The proposition for consumers is very strong. It's time-saving, easy to use. You get a broader range of restaurants than you might not otherwise think of. You can look up a cuisine online and find all the restaurants offering that. You can see the full menu. They save your orders, so you can reorder in basically a click. You save your credit card, your address information. And more frequently now, you get updates in terms of when your order was received, when it leaves the restaurant. In some places, you can even track the driver in the process of delivery. For restaurants, the value added is also very strong. Certainly, you're bringing customers to restaurants that they wouldn't otherwise have. You let the customers pay for placement, similar to what I talked about with Mercado Libre. They're providing analytics to restaurants so that they can think about the items that they're selling and what sells the best and what they should offer, and maybe special promotions that they should offer along with a certain main course. You can refine your delivery estimates so you don't have unhappy customers waiting for their food well past the estimated delivery time. They help customers refine the delivery radius. So you may be delivering to an area far enough away from your restaurant that just isn't profitable. And increasingly, they're offering things like discounted supplies, pizza boxes, delivery bags, credit card processing. If you do payment processing with them and have the right terminal, then you get a break in your credit processing fee. They're looking at discounted utilities. And these are all great things, not only for saving money for the restaurants, but further earning their loyalty and increasing the stickiness of the restaurants on the platform. Now, while ordering online is not new, we think there's a fair amount of runway left. Online penetration for food ordering in Just Eat's markets kind of varies from 15 to 50%, and closer to 50% in the UK, one of their more mature markets. But orders there continue to increase rapidly, growing in the most recent quarter by 22% over the previous year. Like Mercado Libre, they're asset light, generate strong free cash flow, and do tuck-in acquisitions in order to maintain their #1 position in each of the 12 markets we showed on the preceding slide. In terms of what we're watching, we do watch for competitors. Uber Eats is now a popular one that's been building. So far, Uber Eats is more focused on chains. Just Eat is more focused on independents, and seem to have their own space. But clearly, we watch the competitive environment closely. The last company I wanted to highlight is Shopify. Now, while Mercado Libre and Just Eat face off against the consumer or link consumers with retailers and restaurants, Shopify offers a cloud-based software operating system to e-commerce companies. Business started in Canada in 2006. The founders were looking for a way to sell snowboards online. That's the company that we have here is Snow Devil, which was the company that they owned at the time. Looking to sell them online, they looked at software that was available to them and found that most software for e-commerce was really geared to larger companies. Didn't offer the ease of use, the simplicity, the kind of working right out of the box that they were looking for as entrepreneurs and hopefully small business owners. So they developed that and left their online snowboard business to the side and developed what has become a very successful company, software company. Today they have 500,000 merchants in 175 countries. Main business is in the US, Canada, Australia. They essentially act as a one-stop shop for retailers, providing things like templates to build their website or platforms for them to build their website. They offer payment processing through a partnership with a company called Stripe. They're beginning to offer working capital financing to customers who use them for payments, and clearly they're in a great position to do this because they see the revenues coming through for the business. And either within their own software or through apps, and they have a software or an app store with 1,400 apps available on it. They offer tools for marketing and promotion, things like recovering an abandoned shopping cart online, automated inventory control and order management. And this is important online, but it's even more important when you think about selling not only online, but through email promotions and selling through social media and maybe a brick and mortar business as well. They offer integration with accounting software, and over the last couple of years started offering shipping and arranging for shipping. And all of these help their customers grow, which is important certainly for their customers, but it's important for Shopify as well, because a part of their revenues come from transactions, the value of transactions processed on their site. And clearly it builds in stickiness. Again, once you've got this kind of ecosystem supporting you on Shopify, you're unlikely to change. About half their revenues come from subscriptions. They start at $29 a month and go up to $2.99 for the core business. And the other half come from these services that I talked about, shipping, payments, merchant advances. And while they target small businesses and small business owners and entrepreneurs, over the last few years, they've developed a business called Shopify Plus, which targets much larger companies with $1 million or more in revenues. And so in their customer base, you'll see companies like The Economist. Oreos did a special promotion. Budweiser did one promotion, and it worked well enough on their website that they now have 6 promotions going. It's an easy pop-up way for political campaigns to sell their merchandise. So in the U.S., the Trump campaign, the Clinton campaign, and the Obama campaign all sold their wares. Celebrities sell their wares through Shopify. So Lady Gaga, Adele, Justin Bieber, if you bought any of their merchandise, you bought it on a Shopify website. Excuse me. The company is clearly growing rapidly. That's one of the challenges in forecasting their growth is they've continued for 10 quarters in a now to report beat and raise quarters. What we're focused on is their turn to profitability. They're just now reported their first profitable quarter on a break-even or on an adjusted basis, and we're watching to see the investments that they make as they turn to operating free cash flow positive. Lastly, I want to turn just for a second to the Franklin Concentrated Global Equity ex-Australia portfolio, the SMA that was recently added to the Hub20 platform. In this portfolio, we invest in about 20 companies, all driven by our bottom-up fundamental research. So we're owning companies like the 3 that I just talked about with a tremendous amount of research behind the purchase and behind the company during the point that we're selling. We focus on work on growth, quality, and valuation. So we're owning high-quality growth companies that we can own for a number of years. And we have an approach that while the portfolio is concentrated about 20 companies, it's diversified. So we look to limit the overlap of underlying economic drivers in the companies that we own. I think with that, I'll turn it over to the next presenter.
Okay, thank you very much, Don. There's some interesting insights on what's driving growth in the e-commerce sector there. So we're now going to hand over to the Commsec team to present on what's driving advisor demand for managed portfolios. Thank you.
Thank you very much. My name is Paul Ashworth. I'm an analyst at Commsec Investment Management. I'm here with Nick Bulgren, who's the investment manager for Commsec Investment Management. We do apologise in advance for a little bit of shameless promotion of who we are and what we do. We've just recently been added to the Hub24 investment menu, our 3 Australian equity portfolios. We're listed under Australian Investment Exchange, Commsec Investment Management, or Commsec being the portfolio manager. Our team has been around for a while, but we've only just started to move into the buy-side portfolio management space. We've been assisting financial planners for about 10 years now in constructing and delivering direct equities or direct investment advice to their clients. And so there's a little snapshot of the team up on the screen now. We've got a very strong team of analysts, but the best part about working for the Commonwealth Bank and Commsec primarily is the access to a broad range of economic insights, research, the whole machine that sits behind Commsec and the Commonwealth Bank is a great asset to have on our side. So whilst the team is small, we have a large service team that works within Commsec Advisor Services. We also have a large distribution team of about 40 people in total that work around us and support us in our service delivery to financial advisors. So the important thing to call out around what we do is we are a wholesale service only. So most people may identify Commsec with being your mum and dad investor and services to the self-directed client. However, our team do not have any end clients per se. Our clients are financial planners, and so we've been designing and managing a range of portfolios for the financial planner and helping them deliver direct investment advice to their clients in a wholesale nature. So it is the financial planner's advice. It is not our advice or they're not our recommendations. The advisor owns the recommendations, and so we've been working in the background with planners for many years and typically providing them with bespoke portfolio solutions. So clients will come to an advisor looking for exposure to direct shares. They may already have a direct share portfolio or be looking to invest in one, and the advisor may not have the propensity, the ability to be able to research and construct a share portfolio in line with their client's objectives, and that's where we come into play. And so advisors work with us and dealer groups work with us around the design and ongoing management of those portfolios. And we also provide typical broking services. So we execute the share trades and provide you with those services as well. So you don't have to outsource the trade execution to another member of your team or whatever it might be. So where we can help advisors around everything to do with the end-to-end delivery of direct equities advice or direct investment advice, we do.
Now, what we thought we would do, we wanted to give you a bit of an explanation regarding who we are and what we do, because by doing that, we can, I guess, give you an idea around the insights and the partnerships that we've created with financial planners and the learnings that we've had over the years and how we've been able to evolve our services to meet some of the changing needs for financial planners, which I think also then goes to explain why managed accounts has taken the ride that it has, especially of late in the Australian market. But look, to put into perspective how we operate, we consider ourselves an insourcing of an equity solution. So what that means is that we provide a basis of recommendations for financial planners, for dealer groups, for platforms. We provide all the support and service that goes with that, because at the end of the day, it is still the planner associated with our service who owns the advice. So we want to make sure that they're the experts. We want to make sure that they're covering across everything that they need to be. And by going through that process and being part of the Commsec network, we've dealt with a very wide range of different dealer groups and planners. They can be from one-stop shops in the suburbs to national dealer groups that manage hundreds of advisors. And I guess because we bring ourselves into the advisor's office, we get a really good idea as to what are the challenges that they face, what are the pain points that they're confronted with. And by doing that, we've managed to really evolve our service over time and continuing to change to where we are today. So I guess some of the learnings that we've got from our years of experience is that we've really seen the evolution so that financial planning isn't just about managed funds. So previously, you look back 5-10 years ago, managed funds was by far and away the majority of investment dollars for financial planners and their clients. What you've seen is a real evolution where the ETFs and ETPs, so exchange traded products, have taken rise. advisors are looking to deliver differing services. They want to look to add additional value in the eyes of their clients. So we've also seen the rise of direct equities. Now, by going through those avenues, advisors have found it difficult to administer. So by increasing the sphere of available products that they have, comes difficulty in administration. They need to get the data, they need to be across all the information around it, they need to be able to report on changes, they need to be across, you know, what potential changes there might be in the underlying investments as well.
And so we've seen advisors broadly tying themselves in knots by doing what they do best, and that's delivering excellent service to clients, but not everyone, but a little bit of trying to be everything to everybody. And you know, whilst that's great from a service perspective, if you're trying to deliver a managed fund portfolio that your dealer group prefers you do, but your clients are coming to you and asking you what exchange traded products are, or what's this listed investment company, or I want to buy this share or that share, or I've got a direct equity portfolio, particularly around self-managed super funds, which is where advisors are wanting to specialise now. A lot of that's direct equity portfolios, and it's not easy to transition them to a managed fund or transition them to a exchange traded fund. So the demand from clients are seeing advisors who are traditionally managed fund distributors want to deliver direct investments, now wanting to move back into managed investments because of all the associated costs and administration, and the fact that now advisors, we have to charge for our services under a very transparent fee structure. And embedding that value into your business is very, very difficult to achieve at scale. And so we're seeing that full 360 back to managed portfolio solutions now, but obviously at a better cost and a better outcome for clients.
That's right. And so with that additional cost, the increased demand for transparency, and also the advisors still needing to actually make their own businesses profitable, it's really seeing the rise to managed accounts. So we can see here on that slide, the numbers have increased substantially. So managed accounts, I mean, we've been hearing the noise of managed accounts for years now, and they're not necessarily a new concept in and of themselves. So managed accounts have been with us for a number of years, but you can really see that the spikes in the last couple of years around the actual usage. So previously managed accounts were available on specialised platforms, but now what we're seeing is the growth of other platforms such as HUB24 and some of the other ones that aren't associated with the major banks and things like that, that have really been increasing. And also the major platforms like Macquarie's, like FirstRap, like BT, these platforms are all having to answer to these challenges as well. So broadly, the whole market is really now starting to support and provide solutions around managed accounts. And platforms like HUB24 have been leading the way in that front. But you can see there around the usage, and advisors are really getting behind it. Now, with the use of managed funds, as with anything, it goes through teething issues around the fact that in theory it sounds like a perfect concept, as far as everything can be run efficiently, they can still have the portfolios managed by investment professionals, and they can continue to make their own earnings over the top of the financial planners themselves. But as time goes by and we get more and more advisors and more clients with exposure to managed accounts, then managed accounts in and of themselves still have their own issues. And so what we're really looking to do is try and actually identify what those issues are and how advisors can actually get over those and continue to provide a high level of service to clients. So some of the things that we're seeing is that with that increased transparency comes increased questions. I mean, the clients themselves can now see in their portfolios, well, I've got BHP. Why do I have BHP? I noticed that this has happened on BHP because, as Donald alluded to earlier, the clients themselves have such access to information regarding their phones, tablets, laptops, all those sorts of things. So clients are more informed than they've ever been. And advisors are then needing to actually provide explanations behind why their clients' investment exposure are as they are. And so with at Commsec Investment Management, this is what we've specialised in for years. So by working in a more broking sort of sense, where we deliver bespoke portfolios and specialising in that direct equity space, that's really where our expertise lies, where it's really about the service, making sure that that advisor is continued to be provided with all the information they need it to be, because the advisor still needs to have a spot of value in the eyes of clients. They need to be the expert. And so advisors really need to make sure that they continue to position themselves as such and have the tools and support around them to do so.
And the key aspect and the key challenge that we're seeing in advice businesses now is the systems and the structures they have around managing their client portfolios. So we see a lot of demand or a lot of driving of different platform options, but as all advisors will know, not one size fits all for clients, and typically not one direct investment management option suits your clients. So you're going to have clients with a sprinkling of managed funds, with some managed portfolios, with some direct equities and maybe some ETFs as well. And the strength of our service is bringing all that together and helping you decipher that, but also providing the systems to help an advisor back that up and still be the expert in the overarching strategy, but have the appropriate level of knowledge and I guess around the underlying investments so that they can have those robust discussions with clients and more detailed discussions if needed.
And so that way the advisor can continue to add value to clients, and really getting back to what a financial advisor really should be focusing on, which is that overarching strategy. I mean, an advisor, we see it often with advisors, they really get too stuck and too concentrated on trying to pick whether BHP is better than Rio, whether this strategy is better than that strategy, but really the value for a financial planner and financial advisor is the overarching strategy. It's making sure that the client has the correct structure, making sure that they've got their transition to retirement in place, making sure that they've got their cash flow management in place, making sure that their estate planning, their risk management, all those aspects. That's really the value associated with the financial planner, and that's what clients are going to a financial planner to actually receive. That's what they want. That's what they're expecting to get, and that's really where advisors should be focusing on. So the managed account offerings really enable the advisors to put the focus in those correct areas and leveraging off experts in these particular areas to ensure that they continue to deliver that high value. So within Commsec Investment Management, so what we evolved from our bespoke portfolio service, where we deliver, and we continue to deliver this service, we deliver individualised portfolios. A number of years ago, we launched our model portfolios because we saw that need for advisors looking to create greater scale in their businesses, and so therefore we provided more templated advisors that were easier to follow. And now I've made that available in the managed account space, where you get the full box and dices around performance reporting, around not needing to complete all the ROAs and all the paperwork associated with typical investment advice, and therefore saving advisors an incredible amount regarding efficiency and administrations. And so what we've got now is a team that provides all those services whilst providing consistency in investment approach. So overseeing each of these services is the one investment philosophy and the one investment committee. So advisors can now pick which service suits individual client circumstances whilst having consistency across their full investment outcomes. So that if there's an announcement on BHP, on CBA, on whatever it might be, the advisor knows, irrespective of what particular service the client has, it is a continuation of the investment philosophy, and each client will have a similar outcome.
So we've got some contact details, obviously. At the end, feel free to touch base give us a call. We consult to dealer groups, financial advisors, independents, boutiques, aligned, all types. But if you have any questions, feel free to pick up the phone or send us an email.
Thanks. That's great. And now we have actually had some questions come through. So first of all, a question for Don. It's interesting you haven't mentioned the FANG stocks. I haven't heard of any of these companies. Why do you feel they are better opportunities?
Well, certainly the FANG stocks are great and successful businesses and have been great investments for investors over the last few years. We don't own in the SMA. We don't own any of these companies, but it really is a kind of more kind of stock-specific issues or questions on their fit within the strategy. In a couple of cases, they're corporate governance, and Facebook, for example, where you have one man, Mark Zuckerberg, basically controlling the business and controlling the board. That's an issue for us from a corporate governance standpoint in terms of what we like to see in our portfolio that gets to the quality aspect or the governance aspect that we look for. And again, doesn't mean that he's not brilliant or that Facebook isn't a great investment, just for our strategy isn't right. Google has some of the same kind of highly concentrated ownership and board decisions. Netflix we've looked at, again, a very successful business. The challenge for us in terms of Netflix for our strategy is cash flow generation, where they just continue to invest more and more in user acquisition and in programming. And Amazon, again, clearly a great company and a great business. The interesting thing about Amazon is a tremendous amount of their growth comes from Amazon Web Services, which they just started breaking out a couple of years ago. So it's last year about 9% of their revenues and about 75% of their operating earnings come not from their stores and what they're known for, but from selling web services to other companies. So as I mentioned earlier, I think the companies that we own are benefit from some of the same drivers that these companies do, just a little bit lesser known, and for us just fit the strategy better for a number of reasons.
Thanks very much, John. And one for Paul and Nick. In reviewing equity portfolios, what sorts of common mistakes do you see advisors make with portfolio construction?
Well, in the direct equity space, especially here in Australia, there's a high concentration towards the banks, Telstra, BHP, those sorts of things. So I often get portfolios where, especially years ago, I used to get that have all four of the banks, maybe a Telstra, maybe a Wesfarmers or a Woolworths, and that would be about it. And the advisor would then challenge, go, well, this portfolio has performed fantastically, so why do I need to change it? You're telling me to change out of these great companies, and we're looking to add additional ones, which they're perhaps not completely on board with, especially when those bank and Telstra dividend yields were in excess of 7-8% plus franking. So, but what you've seen in the last couple of years is that strategy really would have underperformed relative to the market. So I see a number of advisors really trying to stick to those old big name stocks and highly concentrate in those, but it means that those portfolios are going to have, they're going to be exposed to the same sort of thematics. So when they move collectively, which means if they do well, they're all going to do well, which means if they do poorly, they're all going to do poorly. And so your portfolios can really suffer as a result. So just getting stuck in those sort of over-concentrated positions.
Okay, thanks, Nick. And on another question around diversification for you, Don, how do you manage diversification in a concentrated portfolio?
Yeah. Our approach to managing diversification or really managing risk in the portfolio through diversification is one that, like everything we do, gets back to the company fundamentals. And so we think about the underlying drivers for the companies that we own, and we look to limit overlap among the 20 holdings to those economic drivers. And an example of that is Just Eat, where, as I mentioned, is number one position in 12 markets around the world, but the UK is still about 60% of their revenues. And so we would think carefully before we added another consumer company to the portfolio or another company with consumer exposure to the portfolio that had a large amount of exposure coming from the UK. We'd be doubling up on exposure to the UK consumer. And it's not that we're making a call on the UK consumer or the UK, and we're certainly aware of the risks to the UK economy from Brexit, but it's more just in general we want to limit the exposure we have to the portfolio. So in doing it that way and looking at the underlying fundamentals for the companies and thinking about what drives the companies and looking to limit the overlap, then you can build a portfolio of 20 companies that has fairly moderate risk relative to the benchmark.
Okay, thanks, Don. And one more for Nick and Paul. Nick or Paul. We've seen the rapid emergence of new exchange-traded products and LICs. Does your team provide recommendations on these securities?
So yes, we do. We do assist advisors with recommendations around exchange-traded products. But to the first question as well, I think it's important to point out, really need to think about how you're using these investment vehicles and the roles they're playing in portfolios. We're seeing a lot of fund managers now switch to listed investment vehicles, reducing fees, and that all makes sense. And a lot of fund managers may be chasing their tail around bringing listed versions of their products to market. But then, are those, it's great to get involved and distribute those to your clients, but what role are they playing in a portfolio, and are they fulfilling that role? And with the emergence of these products and the fact that there's so many of them now, you don't want to own all of them. You can't own all of them. There needs to be a real purpose behind why someone might invest in them. And a lot of self-managed super funds are picking up on this, whether if they're managing it themselves, and then they're bringing it to an advisor at a later stage and saying, well, hang on, I've got 4 Australian ASX 200 listed investment companies in my portfolio, plus I own CBA, Westpac, NAB, Woolworths, Telstra. It's just, once again, tying it up into knots. So yes, we do provide recommendations around this, around these products, and so happy to talk to anyone who wants help with those.
Fantastic. Thank you. I think that is the end of all the questions for today. If you want to get in touch with either the Commsec team or the team at Franklin Templeton, please speak to your BDM. We're happy to facilitate those conversations. Also, just to let you know, this is our last HUBsights webinar for 2017, and we'll be back in January, so keep an eye out for who will be presenting at the end of January in HUBsights. Thank you to the team at Commsec and Franklin Templeton for joining us today.